morning. Good morning. I'm just waiting to see if there's going to be anybody else joining us this morning. So we'll just wait to see if anyone else comes in. I usually wait till about 11:35. That gives people a little bit of time. I need to apologise that if you can hear a dog, it's because unfortunately my dog got bitten or stung. We're not quite sure which. So she's a little bit whingy at this moment in time. So. But it happens when you do these things like this. Okay, let's get cracking. So this Q&A session is all about employee finance. Now, as employers, obviously you are an employee of your company. So it could be that you have some questions, but obviously with cost of living and things like that that's going on at the moment, your teams might be getting a little bit more worried or concerned or just more focused, I suppose, on their finances. So you all know who I am, but I'm going to hand over for a couple of minutes, just a couple of minutes, Richard, just to introduce you to Richard and let him explain who he is and what he does. So over to you.
Hiya. My name is Richard Barron. Work with a company called Sterling Welsh Limited. We're down in the Mumbles in Swansea, and we've got an office in Cardiff as well. But by lots of people, I suppose a lot of us are working from home as well. So we do a couple of days of a week in the office and a couple of days at home. We're a holistic practice, which is a term that you'll hear quite a lot in financial services. And what it means is that we can look at finances from, whatever area that they're coming from. We handle things like mortgages, pensions, investments, commercial mortgages. Just chatting earlier with Kate on a question about debt as well. So we can look at debt management and assisting people with credit issues into mortgaging. We also do estate planning, so we write wills, LPAs, and we also look at the tax implications around areas, things like lifetime allowances for pensions, inheritance tax liabilities, and ways of mitigating that. And just generally, we try and aim to get our clients to whatever plans and objectives they've got in their lives, and that can run over periods of years or sometimes transactional. So I need a mortgage, I want it by the end of the month, we can sort that out. And I want to retire when I'm 58 and I'm 38 now, then we can put plans in place to make sure that happens. And fingers crossed we'll still be around to help you then as well.
Perfect. Okay, so we've had some questions sent in to us, which we're going to answer. If there's any other questions that you've got as we go along, then please feel free just to pop it in the chat, and we will be able to answer those ones for you. If Richard needs a little bit more time to respond to it, then we will come back to you. We had a webinar last month, Richard, where we had to come back on a couple of questions because they needed a bit more time. So don't feel pressured that you've got to answer everything straight away. Okay, so let's go into our first question. So I have 4 pensions, maybe more, a little bit suspicious. What is the best thing to do with them?
Okay. Well, having 4 pensions is not unusual. Nowadays, people will have a varied and colourful work life from leaving school or college, and quite often, especially nowadays, you'll have a pension with every workplace that you go to. It depends on the particular pension of the company and what that will look like. And if you've got more than one, then there's no problem with that. It would be rare that you would be putting into, topping up more than one pension at a time. And quite often, what is useful is to make sure that the pensions you've got and the pension that you're in is on a plan to achieve your life objectives. And normally for pensions, that's about retirement. And if you've got money sitting in a pot, not doing what you might like it to do, then moving them around is often a good idea. Not always. What you need to do is make sure that you're not moving something into a position where it is not as beneficial as it was previously. And the reason I'm being cautious with my wording is defined benefits, pensions, which are things like you get when you're a teacher, when you're a nurse, when you're a doctor, public sector pensions, We don't do anything with those much. There's nothing you can do with them. And historically, you might have had a similar pension, for instance, with British Steel, went to Tata, or the Coal Board, where you would finish on a percentage of your final salary. In more than 99% of cases, moving that is the wrong thing to do. So we certainly wouldn't advise that, but every case needs to be looked at in isolation. And we've got to make sure that we do whatever's best for the client. It can be moving it, amalgamating them, or not. Again, it depends on the particular circumstance, but be very cautious of anybody that tells you you need to move them into one if you've got 4. That may be the right advice, but it might not be as well.
Okay. And what, on this question, obviously they've asked maybe more. What happens if you can't remember?
Well, if you can't remember, again, very common. Don't feel worried that that's an issue. There are ways of finding out if you've got a pension and who it was with, where it is. We can access that. There's a pensions record in the country, and we can go back using your national insurance number and some other bits of personal information to find out details on those pots.
Okay, perfect. And with the Nest pension, because I often get asked questions about this, is it easy to move the Nest pension from one to the other like the government wanted us to have, or is it quite difficult to do?
It should be more straightforward than it is. And the danger with the danger with pension is you're allowed to do whatever you want with your pension, but it is unwise to do very much with them if you don't have sufficient knowledge and understanding of the implications down the line, which is why we'd all, with financial advisors, we'd always advise that you get advice, and make sure that you've got a good conversation with your financial advisor and that you're all on the same page in terms of your life objectives. Your financial advisor is there to help you achieve them. And I've met a client this week where actually he's done a really good job of it on his own. He's 56. He wants to retire at 60. He's probably 92% of the way there. There's a couple of bits and pieces that we're going to help him out with, but he's managed that himself. Not everybody's in the same position. So get the advice and then work from it. The other issue that often comes up when we talk about that is people think financial advice is expensive. We've got to charge for what we do, but we try and make sure that it's proportionate. And in fact, the FCA insists that it's proportionate and good value for money. We have to prove that, so that's part of the job that we do.
Yeah, I think as in America, it's quite standard to have a financial advisor, but in this country, I think we're all a bit scared. So don't be scared.
No.
They're not all ogres. Okay, next question. How much do I need to save to be able to retire at 55?
That's a great question. Really good question. The question, what that question actually says to me is, what does your retirement want to look like? You've got choices in the same way as you do when you're working. We can go and earn sufficient to pay the bills and keep a roof over our head, or we can earn sufficient to have a couple of nice holidays a year, go skiing, put the kids in private education, have a camper van, 3 dogs, 2 horses and a goat. You've got to provide for that. So a very basic retirement would probably look like something at the moment in today's money, a couple of £1,000 a month, £24,000 a year. You'd expect to have your money off, and that is going to allow you to not worry about your bills. You're not going to be driving around in a Bentley or anything. But that would be it. If you go up to £40,000 or £50,000, then you're looking at a very comfortable, nice retirement where you go on a couple of holidays a year. And if you want a rock star lifestyle, then you're looking at £80,000 or £90,000 a year. So the answer is, how long are you going to live? And we generally, we don't know the answer to that one. But you tend to go from ONS figures. So if you're 55 now, then you're likely to be living to between 85 and 90. So have you got enough money to provide you £2,000 a month for 30 years?
And just for anyone that doesn't know, ONS is the Office of National Statistics.
Sorry,
if I can say that word, because some people might not know. And they have reports coming out. So if you ever want to have a look, just Google Office of ONS or Office of National Statistics, and they've got statistics on everything. So you can go and have a look at that. Okay, so if you've got, so say this, whoever this person was, wanted to retire at 55 and they're currently 45 and they're way behind in what they're wanting to do, can they, obviously the government forces people to have a certain amount every month, which I think is really good, unless they opt out. But can somebody add more into their pension pot if they want to? And are there any drawbacks or benefits of doing that?
Yeah. So the government, insists now that everybody's got access to a pension in the workplace, which is, like I say, a great idea. The danger with that is that a company, if you think of it from a company point of view, they want their employees to be going home with as much money in their pocket as they can, because that keeps their salary costs down. So the pension input tends to be at the lower end of what we look at. And I quite often speak to people, particularly when we're doing mortgages, because that'll be the first conversation I'll have. And I'll say, if you've clearly got a workplace pension, what are you putting into that? I said, oh yeah, I would do a pension. But you've got somebody earning perhaps £25,000-30,000 a year, and they're putting £30 a month into their pension. Now that is not sufficient to enable them to retire at 55. It's going to be, things are going to be tight. If you want to put more in, and again, the calculation is fairly simple. What do you need to live on a month? How many months are you going to live? And that's what you need to have when you retire. Getting there can be improved by investments and the rates at which things go up. And there's a fairly complicated piece that we need to do on that called attitude to risk, capacity for loss. But in terms of retirement, the pension is a really, really tax efficient way of ensuring that you can save effectively. So the money that goes into your pension goes in before you get taxed. If you want to put more money into it, you can. If you put the money into it after you've been paid, then the government will add the tax back. So you'll get the tax rebated. So effectively, you can put money into your pension without it being taxed in order for it to grow, so that when you retire, you'll get it back out, at which point it will be taxed as income. So the tax doesn't go away. If you run a limited company, for instance, and quite a lot of clients are like that, then maximizing the amount that you can earn using the pension allowances is a very good way of being tax efficient. And again, I'm using my words carefully. You don't want to have money sitting in a limited company account that's paying corporation tax when you could have given it to yourself into a pension tax-free and benefited it from that way. And sometimes it's a case of like, well, I don't need the extra income. Well, that's fine. Don't pay tax on it. Put it into a pension, and you can get it when you do need it. If that makes sense.
Yeah. And I suppose it's similar to bonuses as well. So I know with a couple of clients, because in smaller businesses, it's easier to do it. But obviously in larger businesses, it depends what their infrastructure is. But if you get a bonus, you could say, if it's £1,000, £500, can that just go in as a one-off payment into my pension pot? And I'll take £500 so I can go and buy some new shoes, for example.
Yeah. Well, take it. Go and buy your new shoes when you're 55, and you take a tax-free lump sum. Buy them if you can last. But yeah, again, different pensions will have different rules. But the principle exists that yes, you could put single payments into a pension, and the tax will be regarded in the same way.
Yeah.
Again, you need to be clear that pension scheme you're in will allow that. And if it doesn't, then you can set up an additional one that will allow that.
Okay, that's good news. Okay, fab. Okay, next question. What is better, to invest in property or pay into a pension pot?
Okay, right. So coming from my own experience in this, I've got a couple of properties, which have built up over the years, and this question really lends itself more to the idea about the way that we're taxed on those now. And owning property or investing in property can be done in one of several ways at the moment. So if we're thinking about buy-to-let property, so a house that you'd have that can be rented out, is something that lots of us have done over the years. the government have spent some time and energy working out ways to make that less attractive to individuals nowadays. So the tax regime on it is not as advantageous as it used to be. So they tend to be going into limited companies, which is not scary. Mr. Jones sets up his SPV, Special Purpose Vehicle, which is a limited company designed to own a property, charge rent, and function the investment that way. There's more tax advantages to that, so that would work. And you can have more than one of those. You can build it, build your property portfolio in that way. But when you buy a property, you're paying stamp duty. When you're charging rent, you're going to pay some sort of tax on the income, whether that comes as personal tax or through an SPV, limited company tax. So the tax that you're paying out while that's going, you're going to have to generally pay for some in finance as well. So you'll have a mortgage on it, you've got interest to pay, and all of those things detract from that bottom line profit. Property still increases in value fairly steadily, and has really good times, which we've had the last few years, and also leaner times, but generally property doesn't go down. But when you dispose of that asset, you'll have capital gains to think about as well. So the tax regime around property investment is quite heavy. The tax regime around a pension, like we discussed, is fairly relaxed. So you don't pay tax on the money going into your pension. You pay it as when it comes out, so it can grow tax-free. The money goes in before you pay tax on it. So you'd see a pension pot growing quicker and faster probably than properties, and a lot less hassle.
Okay, perfect. Okay, so I think we're going to move from pensions now into mortgages. And I think it's this week, isn't it? So whoever asked this question was in it. So I've heard about the 100% mortgage. Is it a good idea?
Okay. Well, you probably heard about it at the same time we did. There was no forward forecasting on that one, and we've had a little look at it. It depends on your area, but it's a fantastic idea. And one of the big parts about it is that actually it's given us a little bit of confidence in the way that lenders are thinking about the next few years, which has been a little bit uncertain. We've got the Bank of England meeting as we speak, actually, and expected to put rates up again today. So the costs of mortgaging are increasing, although not directly related to the Bank of England rate. There's seen a big disconnect in that, which historically they were very closely linked, but now they're less linked. But there's certainly upward pressure on rates. And the 100% mortgage, it's about the inability to be able to save for a deposit and pay rent. And Skipton have clearly put some energy and effort into thinking about this, and it seems like they've got a reasonable proposition. There are a few criteria areas around it, which limit the amount that you can borrow depending on the amount of rent that you were paying, and in conjunction with the income that you've got. But I think it's a great idea. It makes a lot of sense. The number of people that are going to be able to benefit from it, I think, is not going to be as big as you'd imagine. But Skipton are the first, and they have come out in the past with fairly innovative products. And if they're doing it, then I think more lenders will step on and have a look. The government have also got the 95% mortgage scheme going as well. So, again, it's been a bit simpler in the last year, 18 months to get a high loan to value mortgage with a lower deposit than it has been previously. So yeah, all a good idea.
Yeah, no, I was going to ask whether you think more mortgage lenders are going to follow suit with 100%, because I think when I was a child there was 100% mortgages, and then they obviously stopped. So
there was a time when there were 125% mortgages, but those
not that
days
old. Okay. I get this quite a lot from some of our business owners. So I'm self-employed rather than on PAYE, because there's obviously tax benefits of just paying yourself dividends. Can I get a mortgage?
Absolutely, yeah. Okay. We specialise in doing this, actually. We work with an organisation called Entrepreneur Circle, which is based out of Birmingham, but it's a countrywide thing. And so lots of business owners there. And you'll be aware there's many styles of business owner, partners, sole traders, limited company. They've all got their particular areas of difficulty in getting a mortgage. But yes, it's quite straightforward, but you'd be much better advised to get help with, from a mortgage advisor like us, who knows the market inside out. There's some lenders that are easier to place self-employed businesses with than others. The other one that we get some issues with is agency working and contractors. But again, we've got vast knowledge on which lenders are the best to go to and how best to maximize the way that you're paid in terms of the affordability calculations that would be required, if that makes sense.
No, it does. Makes perfect sense. Okay, perfect. Okay. I don't have a mortgage. Do I need a will? Because obviously, with most mortgages, you need to have a will, don't you? Or is that wrong now?
You don't have a will, isn't will isn't a legal requirement anywhere. And lots of people don't have wills. There are the laws of intestacy, which exist. So if somebody passes away and they don't have a will, they don't have an executor, then there are laws which dictate where the money goes. And the benefits of having a will mean that you get to choose rather than the government get to choose where that money ends up. Because although it is a reasonably straightforward and simple ladder, really, of where this stuff goes, it doesn't always make sense, in every case. So write a will, and it can be done on the back of an envelope with two witnesses, clearly written, dated, signed, and that's a will. It doesn't have to be on parchment or anything, but it does make sense to speak to somebody who knows what they're doing, and that can be a solicitor or a will writer like us, to make sure that you understand what happens to your assets when you die. If you don't have a mortgage, the question then would be, what assets do you have? Because you've got to have something to put in a will. So if you don't have a mortgage, you rent, you lease a car, and all you've got is a hamster and the clothes you stand in, then you probably don't need a will. But once you start to get relationships, get married, have kids, own assets, then it makes a lot of sound sense to make sure that you've thought about what happens to your estate after you pass. But equally, I've got clients who are like, I don't care, it'll just go where it goes. Once I'm gone, I'm gone, and that's fine as well. But as long as they've thought about it, that's their opinion, and we've had the conversation, then we've left the client in as good a place as we could have.
And if they want it to go to the Cats Protection League, that's where it goes.
Absolutely, yeah. But you've got to write it in the will, and it goes to the Cats Protection League. I've just done one recently, actually, where there's a big chunk going to the local Cats Protection League.
The local one.
Not my local, their local. So it's not Cats Protection. It's something in Caerphilly, I think. But yeah.
Okay, fair enough.
Yeah.
Bless.
And quite often, another one is, sorry to jump in.
That's fine. No, go.
Is their pets. So, we'll have single people who never married, not got kids, or anyone really to leave stuff to. But they do have, 2 dogs and a cat.
Yeah.
And they're really keen that somebody looks after them. And it's generally somebody in the family. Yeah. But there's an amount of money that goes with the cat, the dog, the pet, to make sure that they've got, it goes to, in the case I'm thinking about, it went to a nephew who wasn't particularly well off, and there's sufficient money there, and it's in a trust, in fact, so that the vet fees can be paid, boarding, whatever, bits and pieces. So it's just about making sure that your stuff's taken care of.
Yeah. Pets can cost you a lot of money.
Yeah, think about it.
Do you do pet insurance? No. I would advise it if you don't have it. Okay. So this is obviously someone that hadn't seen the 100% mortgage, but not everyone wants to do a 100% mortgage. So with the cost of living, do you have any tips of how to save for a deposit, as anything that they were saving is now just being disappeared into sort of like your weekly shop, because that's gone up sort of like 20 quid a week, whatever it is. So
Well, I mean, if you listen to the Conservatives, and without getting too political, Lee Anderson will put you on a budget of 30 pence a day, and you should be able to save loads into your deposit then. Though reality is somewhat different. Having effective savings is that's the vital thing, and trying to make sure that you've got to live day to day, and if you can't afford to save into for a deposit, then don't do without it. There's no point in that. There's no future for that, is there? With the way property and things are going in terms of cost, I think we'll probably end up as a country in a different position than we started with, where people always aspire to own their own place. If you go to the continent, it's rare that people own the house that they live in. It's quite common that people rent. So there might be a change to that sort of lifestyle. If you're going to be saving a deposit, use things like the Lifetime ISA, what used to be Help to Buy ISA, because the government will add money to it. You're limited on the amount you can put in. It's a couple £100 a month. But when you come to use it as a deposit on your first property, then the solicitors will ask the government to chuck in their 25% bonus. So it's a way of maximising the get to help you out. Look at things like Help to Buy. So that exists now in different forms. And again, it's the time of year where it all changes, but the government will effectively loan you some money for a deposit. So you can benefit from lower loan to value mortgages. And there are things like shared equity schemes. So you'll have housing developers that will have social housing as part of a development, and you can part own, part rent. So get online, have a look at those different bits and pieces. Speak to a specialist mortgage advisor like us, and there are others obviously that deal with Help to Buy. I'm particular specialist with Help to Buy Wales, because it's slightly different where we are, but also Help to Buy England. They've got slightly different rules, and they've got another scheme up in Scotland. But speak to an advisor that's got some history with working with those, because again, there are ways of maximising the amount that you've got and that you earn to ensure that you can get the best deal possible on it.
Perfect. Thank you.
All right.
Next question. And I think this is sort of like a generic one, I think, as in, where could small business owners or managers access training so they can help their teams? Because I do know that the cost of living crisis is putting a massive strain on teams and productivity. They're stressing, they're worrying. Have you got any ideas of where managers can get some help in order to help their own employees?
Yeah, I mean, there are lots of government government areas and government supported organisations, and when I say about the next one, it's called Step Change, and they're a debt management company, debt management charity. But they've got and citizens advice as well. But they've got specific professionals there who deal regularly with people who are struggling financially, especially now. Financial stress comes in a variety of different forms. It can be chronic, it can be acute. It can be my dog's got run over and I've got to find 1,500 quid at the vet's. How do I cope with that when I'm just about paying my bills? You go and speak to charities and areas. Citizens Advice will know an awful lot. Step Change will be much more focused on managing incomes and outgoings, and also sometimes managing debt. So you'll have somebody who was earning 50, 60,000 pound a year, happily going along with their 3 cars on HP, kids in private school, and 14 credit cards, and then gets made redundant, and suddenly there's a huge amount of unsecured debt that needs reorganising, and there's companies like Step Change who will assist with that sort of thing. So Step Change always a good idea. Citizens Advice Bureau, another simple one. But yeah, I'm not sure about other training. Your local advisor like us, we don't charge for a discussion and a chat about what's the best way of saving for a house deposit. It's fairly straightforward. A little bit of knowledge on a Lifetime ISA, LISA. We can assist with that. Make a charge for that, because you'll be looking at a client who hopefully will be coming back to you to sort their mortgage out in the future. So
I think quite a few banks are doing stuff now as well, as in to help
banks will, the FCA, which is the regulatory body for us all, they put pressure, is probably the correct term. There's something called the PRA, which is in charge of banks and making sure that they're lending sensibly, not like the 125% mortgages. The PRA came in after that. So a bank will also have some good ideas, but the difficulty with a bank is that they tend to be tied, so they can't advise on anything other than their own product. So always better to go and find independent advice. And that's the word you're looking for, is independent financial advisors, independent charities and things, so they're working for themselves.
Okay. Well, those were all the questions that we had in prior to the Q&A. I'm just going to see whether anybody's got any other questions that they would like to ask, just whilst we're waiting. Is there anything else that you think might be changing in the next 12 months that people would be, as well, in the next couple of months, actually, with everything that's going on? You're saying about interest rates going up. Is there anything else that you can think of?
No, it's a changing horizon at the moment, and the Bank of England are kind of going their own way. That they've got pressure externally as well from the Fed in the States, and globally there are pressures on economies, and so I think we'll continue to see this rate rise now. There's possibly going to be another one. The lenders think before the end of the year, but I think lending, if we look at 5-year marketing for money, which is where the mortgage lenders get their money from, then the rates there are a lot lower than we're seeing at the moment. So probably the forward think is that we've reached the top and interest rates are going to start to come back. In terms of our economy and recession, that's been on the back burner for a little while, and we seem to have escaped it by the skin of our teeth the last couple of times. And whether those statistics that we see posted actually feel like what we're seeing in the shops and around the place, I think there might be a little bit of a disconnect. But fingers crossed, I think we're on the plateau of the worst of it, and things look to be improving slightly going forward.
We've had a question in about cryptocurrency. Is that a good thing to invest in?
Right. What does it actually say? There are many forms of cryptocurrency.
That's what it says. That is what the question says.
Right. So crypto is one of those things that we can't advise on because it's unregulated, and that means that you're really dealing with the Wild West. And I myself invested in crypto a little bit, but it's in the same way as, if I go out with my brother to the rugby on the weekend, we'll often stop in the casino on the way back and spend our last £10. So deal with it in that sort of way. It's not something I would be putting my retirement fund into, although the gains are huge and have been stratospheric. There have also been corrections. So at the moment, if you look at Bitcoin, which is a fairly well regarded one because it was one of the early adopters, it reached a height of I think $45,000 about 12-18 months ago, but it's now running, I think it's around 20. It was as low as 14 or 15. So if we look at investments, and I'm trying to look at the camera here, and you'd expect your investment to do something like that over time. So I'll put my money into a pension and make sure that it grows above inflation, so that, if I can buy 100 bananas with my money today, when I retire in 30 years, I still want to be able to buy 100 bananas with it. And hopefully be able to buy 105 bananas. So that's investment in a nutshell. With crypto, instead of going up slowly like this, it's done this.
There's no consistency.
There is consistency if you look at it over a long enough term, but the problem with it is unregulated, so it's difficult to spend. all the governments around the world are looking at how they can best tax it. So that's going to come in some form. And there are hundreds and hundreds of cryptocurrencies today, whereas in the beginning there was just Bitcoin. So if you know which one to bet on, and I've got a good friend of mine who's spending all day, every 5 minutes, sending me a text. Oh, look at this one! Look at this one! Going Ethereum, going Oasis, going Road. And I'm like, okay, So I move my 20 quid from this one to this one. And our track record is not brilliant, but you've got to be in it to win it, haven't you? So
yeah, no. As long as you've got, it's kind of like gambling, I suppose. As long as you've got a set of money that you can
it's
win.
very much like gambling at the moment.
That's it. Yeah. Fair enough. Okay, we've had another.
It's a good bit. Some spare cash, then it's something to take a bit of interest, and if it brings you into thoughts about financial modelling, how markets move and they change, and that's something that grips you, then yeah. But again, it's not something I'd at the moment be put in my retirement funds in.
No, we've had another couple of questions.
There's wrong with having an element of it. You wouldn't want to miss out, would you?
Do you think that a SIPP is a good idea?
Self-invested pension pot. Yeah, I mean, what we talk about as SIPPs are generally, the pensions that we talk about. The difference with pensions today over historically is really on the way that we access them. They brought in something called Flexi Access Drawdown, which means that you can use a pension almost like a savings pot. And almost, because there are some rules about it. But it's about how you get the money back out. Years ago, you used to have to buy an annuity, and that meant that you build up your pension at retirement, and on that day, you go to a provider and say, right, I want X amount of, or this is what I've got, how much income can I have until I retire? And they'd sell you an annuity. And again, lots of different rules, lots of different products, but essentially that guaranteed you an income forever, or until you died. And then it may or may not disappear. Some of it may go to your spouse, and again, different rules, different products. And for many years that fell out of favour. So you'd have a Flexi Access Drawdown, which was like a savings pot, and when you retire at 55, you've got £300,000 in there, and I want to take £2,000 a month, and that'll last me for 6 years or whatever it is. And some you can continue to grow, some you can't. But again, you're asking for advice on whether it's right for you. You need to speak to somebody who knows what they're doing to make sure that your objectives match with whatever you intend to invest. That's where we step in.
Perfect.
It's easy to make the wrong judgment at the
I can understand
complicated area.
So basically what you're saying is speak to a financial advisor, an independent one.
Not to worry about the costs of it, because we've got to be paid for the work that we do. The FCA makes sure that we don't overcharge. As long as you're speaking to a good independent financial advisor with a reasonable track record and some recommendations, then you should be safe. And it'd be great if you come to us, but if you want to go to someone more local or whatever, then fine. But make sure you do take sound advice, and be wary of taking advice from the bank again, or ringing Legal and General, and not picking them as any different provider, but they would then be tied to their product, so you're not getting a broad idea of what's available.
Yeah. Okay. I think the final question we've got is, I have debt and small savings. Is it worth me talking to a financial advisor?
Always worth talking to a financial advisor. If the question is, should I use my savings to pay off my debt, then it needs to be about the objectives that you've got, what the debt is about. If you've got HP on a car and you're always going to need a car, then you need to run a car. If you like having an emergency fund, which is available there for days of emergency, then it wouldn't be wise to use that to pay off a debt. But again, have a chat with someone like it. We don't charge for that sort of discussion. If you just want some simple advice, then a phone call, and we can do it over the phone just to get a bit of a steer on stuff. Absolutely fine. The hope for us is that you come back when you're ready to get your mortgage or sort your life insurance or your will, and we do it that way.
Perfect. I can't see any other questions coming in. So on the screen now, you'll be able to see Richard's contact details. So if you would like to contact Richard or any of his team, because I know they have different specialisms, then feel free to contact him directly and he'll be able to assist you, hopefully. Thank you very much for your time today, Richard. It's been very enlightening.
No problem.
And I'm hoping it's helped quite a few people. Our next Q&A session is going to be on the 25th of May. And it's how you can generate revenue through training. And that's going to be with Pete Fullard from Upskill People. So thank you so much for joining us today. Thank you again, Richard. And we will see you again on the 25th of May.
Lovely. All right. Cheers, guys. Have a great day.